So a little different mood today than last time. On Monday, we had that big, strong, bullish, parabolic type move on Monday. The question was whether or not that was the beginning of an intermediate trend or not, with kind of leaning towards the or not for some factors we talked about on Monday. Well, 2 days later, we've had a 2 day losing streak. Now we're not falling off a cliff, but we're going to take a look at some of these indicators to see, whether or not this weakness is a function of we haven't started a new intermediate trend, or whether this weakness is just a small part before we continue a really strong bullish move going forward, based off what the indicators are looking like now. So I'm going to break that down. We're going to take a look at what's driving a lot of the price action here lately, and especially with the direction of the dollar. We're going to take a look at that and what that means, and what do stocks prefer, and what kind of trend is the dollar in right now. So we're going to take a look at that. And then we're going to talk about a trade idea where we will trade that volatile tech sector and try to see what can we do with that and how can we trade it, considering the volatility to the upside and potentially to the downside there. So let's go ahead and get started. Today is Wednesday, October the 14th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we've got a little bit of a losing streak that we haven't had for a while. We haven't had a 2 day losing streak this whole entire time. After getting above the 78% retracement of this pullback here, which is really a good sign to get above there, we have since now come back down and are back and lost our green line. So moving average is falling back down again. Intermediate line still bullish. We still have dark green shading, but you notice it's starting to slow down that ascent and then potentially rolling back down, especially with the near-term line. The momentum line not at its lowest point. It was down at these extreme lows again, which you can see. Like every time we pull back, the momentum line, every time it pulls back, it's like small gains to the upside, most of it overnight, and then extreme moves to the downside. I mean, this move to the upside didn't even get the momentum line. It got the near-term line up there, but couldn't get the momentum line up because we weren't getting good solid moves and closing at the highs, because a lot of the moves are occurring overnight with these gaps. But the near-term line has come down, so we've ended this near-term rally that we've had here. So now it's a question of how far we come back on this next decline. And you can see, like, here's the pre-COVID high point that we had from back here. And then there's your 23% retracement level that we're still, there's still kind of a noisy pattern here. So we can easily come back down there for, and just be considered noise as we've had an intermediate pullback. And it looks like we've ended the intermediate pullback, but not necessarily. You can see the same thing on the Dow. The NASDAQ at one point in time was more bearish, again coming off of those lows at the end of the day. But back below that 78% retracement, and the Russell 2000, which has gone through this high point. All the others are just getting up to that 78% line of that high point. The NASDAQ actually went through it, and you can see its pullback. In fact, you can almost argue this is a pretty bullish pattern because its intermediate line is still above 80, right? So you got it's kind of an intermediate confirmation signal. All the rest of them, you can see the intermediate line is just barely getting above the market sentiment on the Dow too, and slowing down how it's rallying. So if they don't get in the reversal zone, the intermediate line on these others doesn't get in the reversal zone, and then they roll over and back below the market sentiment line without that, that's a pretty bearish high point at that point. So this is something to keep in mind as we head towards these retracement levels. Again, remember, going up or down between 0 and 23% is just noise until you at least break through 78 and then stay above it. Like I said, happened on the Russell, hasn't happened yet on any of these others, the NASDAQ or the S&P 500. We've got up through it on a kind of a parabolic move there, but couldn't quite stay there on the upside. But again, dark green shading, yellow line. We got dark green shading, yellow line again on the Dow Jones. Dark green shading, a yellow line again on the NASDAQ. But the Russell is still dark green shading and a green line. So out of all these indexes, the Russell obviously looks by far the most bullish. But the other indexes, not so much, right? They're they're still fluctuating between yellow and green, and we'll keep an eye on that dark green shading, because if the intermediate line rolls back down in the next couple of days, and we'll be back to light pink shading. So we'll lose that element of what would be considered a bullish trend, and that is dark green shading and green line for an extended period of time. You don't usually get extended periods of dark pink shading and red lines during regular pullbacks. Obviously during that COVID pullback you did, but during some of these regulars you can see, you don't get too extended period of dark pink shading. The dark pink gets broken up. The red will stay, but the dark pink will get broken up. Whereas on bullish trends, you can see the dark green doesn't get broken up very much. You can get good long runs of dark green. So we'll keep an eye on, see whether or not this dark green gets broken up pretty quickly, which would be a suggestion that we might not be as bullish. As you can see, like for example there, we couldn't quite get going, and we lost the dark green and went back to light pink there and a little bit of a red. So we had a little pause before we can get going again. But that might be what we're looking at here, but the pause might be a little bit more accelerated than that because of the election that's coming up and all the volatility that's associated with that, at least according to what we're seeing in volatility levels on the options market. All right, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen, hit the red subscribe button that pops out. There's also one down below the video if you're watching us there on YouTube. Also, while you're down there, hit that thumbs up icon. That tells us two things: you liked our video today, and you want us to do another video again tomorrow. Quick way to give us feedback there. I will be out on Friday, so there won't be a Market Outlook video on Friday or a Market Outlook live video. But Brandon will be there tomorrow for tomorrow's video to wrap up the week from our end, as I'll be out of town the rest of this weekend here. Also, while you're down below, comment. What did you get out of our video today? Join our website at marketscholars.com. There's a link popping out right there on the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. And join our Market Outlook Facebook group that we've created. If you're watching us on our webpage here, I invite you to check out some of these other things over here on the right, including our Market Outlook live video. These videos I do every day. I do the Market Outlook. I also do a live video on YouTube at 3:30 Eastern time. This links you to it right here if you just click on this. You can also see it up here in the Market Outlook live trade review right there. We review all the trades that I've put on in these Market Outlook videos, and we continue to manage them all the way up to the time that we close them. We talked about a few today about how we manage them, with some thoughts on how we might close them here in the next day or two. So if you're interested in that, check that out. Also, all of our upcoming classes you can see over here in our events. You can get to these classes by clicking on Trading Rooms. All of our monthly and our premium subscribers get access to all of our classes, including these live trade reviews. Of course, our premium subscribers get access to tools and communities and things and custom content. But even our monthly subscribers get access to all of this. So check that out. Remember, we are doing, if you subscribe to our newsletter, our email newsletter here, we're going to do a drawing here for 1 free month subscription to our monthly subscription. So to put your name in the drawing, you just put in your name and email address there and sign up for our Daily Market Outlook email. All right, now let's go back to the charts. Let's take a look at this weekly chart, and you can see, despite the 2-day losing streak, we still have a higher close than last week's high point on the Heikin-Ashi candle. Remember, the Heikin-Ashi close is much more significant than the actual close because it's an average of 4 prices, especially when you're comparing it from one week to the next. So whereas the high point here of last week on the Heikin-Ashi is the actual high. So we're not just closing above last week's high, but we have the average prices. So big move. Helps the gap up, but gap up to the upside brings that open price up higher. But a nice good rally, and even the two-day losing streak hasn't altered that. But remember, we're already starting off a relatively high PPO here, so that's why, again, another reason to be a little wary and skeptical about how long this, whether we're going to get like 12 weeks of bullishness like we did, this long run or this long run. We might just get a few weeks here before we roll out, especially with this long upper shadow that culminated there. We'd have to close above that high point to really get going, especially a Heikin-Ashi close. Let's take a look at some of these other indicators. You can see what the 2-day losing streak has done. It's brought our RSI back below 50, and we're almost back below 100 on the CCI. You look at the DMI, it's brought the DMI back to 30, almost through it, not quite below it. It's brought them positive up almost above 20 at 18. So kind of keep an eye on those to see if this continues with those oscillators there. We kind of nullify the strength that we've had. You can see we're pulling back towards the Ichimoku cloud. We're not very far up above it. If you look at the 8-day moving average, we're still above the 8 days, so we have some strength there, but the MACD histogram is definitely rolling down to the downside. So keep an eye on that, especially with the stochastics potentially crossing below its moving average. Still in the reversal zone, but crossing below. So we'll see if this ends up being it. Like if we're going to maintain a bullish intermediate trend now, going to the election and through it, which is unlikely, but if that's what we're doing here, if we're starting a new run, then this weakness is about all the weakness we're going to get, according to these oscillators, these different indicators. If it turns into more, then we know that we're not really done with this pullback yet. That this was kind of premature to start, especially with this kind of blow-off type move or parabolic move that really made things get so bullish over the last so many days, with all the gaps to the upside and small ranges during the regular trading session and low volume until that last blow-off type move that we had on Monday. So we'll see how this plays out. My expectation is that there's going to be more to the pullback. I think it's unlikely that we are starting a new intermediate trend right now. Again, with the high PPO, among other things, right? Today in our options inventory trading class, we talked a lot about gamma exposure. The gamma exposure right now would tell us that we should expect more of a pullback to occur, similar to what we had here. So because they're so close to each other, it means that we probably didn't finish this pullback here. All right, now let's take a look at the intraday chart, and you can see here that, again, I mean, we had such a light volume up here, which has made it because of these gaps, and made it very easy to pull back, especially on something like QQQ, where it was even more parabolic on Monday. Just such a big gap in volume to the downside. It's too easy, right? It's too easy for it to pull into this volume area and struggle. And that's what's happening. We broke below yesterday's low point. We retested it, but have stayed below it and pulling a little bit in the after hours. But you can see how easy it would be tomorrow and Friday. You come down to 282, which is at 162%. If you recall, on the longer term chart here, that 162% is of the route. See, we went through the pre-COVID high point, all the way through it and all the way up to the 162%. Then we really went parabolic there, pulled back down below it to around the 23% level, back into it. And again, the lack of volume means we can get back down here pretty darn quick through the 162 down into this area and still just be a noisy move, and very easy. As it went up, just as easy to come back because we went up so big and so fast with these gaps. It was unable to build some support below as we were going and left this big gap in volume. And like I said, especially on the QQQs, you can see it's even, the gap is just that much more wider and prevalent there. So that's what's going on in the intraday basis. Of course, from a volume standpoint, the volume coming back down after being so bullish on Monday. We're coming back down to very, very light volume, which is not too bad during a pullback to have the light volume like this. Small ranges, small trading range. The range was 4.79 points, so below average on the volume. So again, like if we continue to pull back here, we're not going to be falling off a cliff anytime soon. We'll continue to grind our way down. We'll continue to grind our way up on volatility. So it's hard for volatility to spike up because it's already up so high. We're already in the neutral zone. Usually you spike up from lower levels. We're already relatively high here, up above 25. So it's hard to spike up, but it's also hard for volatility to drop on an absolute basis until we have something to drop from here on a relative basis. So until we get to the 105%, it's going to be hard to fall. To really get going, to get a new intermediate trend started. So that's another reason why I'm a little hesitant to say that we're starting a new intermediate trend where volatility will really get going to the downside, because we never have had a big peak. We never did get to 100%. We never got above 95% on this whole pullback that we've been on so far. So again, the worst, similar to other pullbacks we've seen in the past, the worst case for volatility is most likely going to be at the end of this pullback, not at the beginning, which is so typical. So we might retest these 30s levels, but this time with the VIX rising and breaking above 95 and getting up to 100, 105. This by the time, and most likely leading up into the election. Remember, in 2016, volatility didn't pick up until October expiration. Once we were through that expiration, it picked up for those couple of weeks, and we were grinding higher, higher until we peaked out at 100, 105%. Right before the days of the election, Monday and Tuesday of the election. All right, so to summarize my outlook here, obviously we're bullish, but not as bullish. This little 2-day losing streak has kind of made things less bullish, and maybe suggesting that we've had a little bit of a fake out beginning to an intermediate trend, whereas we might not be done with this pullback that started back there a few weeks ago. And then we've had this kind of parabolic bubbly move that culminated with Monday's sharp gap to the upside and sharp finish. So among other things, I mentioned our class discussion today in my options class where we went over gamma exposure. There's a lot of elements there that suggest there's more pullback to come. That this little rally has some fake out qualities to it. And eventually, we're going to get a new intermediate trend started, right? I don't expect us to go COVID low point again, right? We're not going to start a bear market here. So eventually, we will get an intermediate run started, but more than likely, I have a higher confidence level of that starting after the election than before. And we've had this little fake out move, thinking that making it look like it was going to start now, and that might. Give us a little bout of volatility, especially after this October election or expiration, if it follows the same pattern as the prior election cycle that we had in 2016. So what do you think? Do you agree with that? Do you disagree? It's a little bit of a, most people think that we're pretty bullish as of right now. So if you disagree, why? What are you seeing that suggests that either you're still a lot more bullish than what I just said, or that we're going to have more than just a little weakness on the pullback? It's, we are going to go back into another stronger bearish mode. Maybe not as bearish as COVID low, but something similar. So what are you seeing that would suggest that? Post that in the comment section down below. All right, now let's go back and talk about what's driving the price action today. And let's take a look at the different asset classes here and just look at just today. So let me bring this down to October. We'll look at the 14th 10-minute chart. You can see commodities doing very well with some weakness in the dollar today. We'll take a look at the dollar chart here. So that's pushed commodities up, but a risk-off move pushed bonds up. Long-term bonds had a rally. The dollar down. Usually the dollar's up on a risk-off day, so that's a little bit of a difference there, but you can see to the downside, IWM really falling hard, QQQ is really falling hard. I remember, they had such a strong rally here. If I were to go back a week and take a look, up until these 4 consecutive up days, you can see how IWM started off really strong gaps, and then we had Monday's move where QQQ took off like a rocket, a little bit of a, like I said, a parabolic type move. And then you can see now the 2-day losing streak, and it looks like small caps is really kind of feeling the brunt of it. If I just go to this 2-day losing streak, just yesterday and today, you can see small caps, QQQ is actually outperforming SPY, small caps underperforming. So they're feeling the brunt, real estate coming down too. And then you can see up again, the bonds over the 2 days have really had a strong day, which means that bond yields have had a little bit of a pullback themselves. So let's whoops TNX. There's bond yields. You can see that little drop they've had. Again, still a dark green shading, green line, but we have light pink shading now with this intermediate line pulling back down below 80. Still above a rising market sentiment, so there's still bullishness here in yields, a reflection of rising inflation expectations, but a little decline. And I mentioned the dollar move that it's had over the past couple of days too. You can see the pullback in the euro it's had, but then that pullback kind of stopped. So Again, during some weakness, we got a red line going here, so we're still kind of in pullback mode. We haven't changed that red line. The intermediate line's rising. We got light green shading, but even that, the euro's not. The dollar's still rallying while we're in this pullback mode. And it looked like we were going to head up. We've got light green shading and yellow line, and that's a bearish pattern. It's played out bearishly here. So while the dollar is bullish, which it is during this pullback, it's hard for equities to be really bullish. Not impossible, as we've seen the last couple of years, but it's hard to be really significantly bullish. Equities prefer a weakness in the dollar, right? So from this period, from middle of May all the way up to the beginning of September, you know, if you were to take a look at SPX during the same time frame, if we were to look at, again, middle of May right here, from the middle of May all the way up to the beginning of September, equities love to have a weak move in the dollar. From that low point, from the open here, all the way up to this peak, you can see that's a 28% return in equities, an annualized return of almost 100%. In fact, if I were to take a look from May the 15th, let's see, it would actually be, let's go from that low. So May the 14th, May the 15th is when it gapped. Let's see, let's just make sure we got the dates right here. May the 15th is when we spiked up, and really, or May the 18th, excuse me, is when we spiked up. Now keep in mind, it's the day, see, we're already showing October the 15th. So that was really May the, what would it be, the day before. So it'd be May the 15th that we had that move. And then you can see we peaked up here on September the 1st. So let's go back to the asset class comparison here. And let's take a look at May the 15th. So May the 15th, all the way through to September. And we'll go up to, let's see, where was it? September the 2nd is when this finished. There we go. Keep it on the hourly chart. So there's the move that we had. Again, big strong move in the S&P 500 with that big move to the upside in equities. Initially, it was driven by small caps in real estate, right? Remember that catch-up trade that peaked in June, but then they've really lagged. Small caps, not so much. Small caps, again, had another leg higher here in August, and then they've gone flat since then, and the Qs have really taken off. So the Qs are up 36.5%. During that time frame. You can see how weak the dollar's been, and then of course bonds, not a little weakness, not a whole lot. They had a lot of weakness here early, but then they've kind of gained some strength here during that rally. And then gold doing well too with the weakness in the dollar, but lagging equities, right? So, you know, just gold doesn't have to go down when stocks go up. They'll just lag behind during a risk-on move, and they'll outperform during risk-off moves. You can see there's a period here where gold really took off. And the dollar dropped, and gold outpaced, and even bonds rallied there. Gold outpaced equities. It was really from the 7/16 time frame up to about 8/6. So 7/16 here to 8/6 is where you had that strong move in gold prices. There you can see, you know, we weren't down. Equities were up 4%. Bonds were up too. 3%. So everything was up. The dollar was the only thing that was down, and that pushes, you know, everything up at that point. But like I said, gold, you know, even while equities are bullish, ultimately during this period that the dollar was so bearish, stocks did very well. I mean, to have a 6-month some odd return of 36.5% on QQQ, you can see how the market prefers to have weakness in the dollar, and there's going to be opportunity for that weakness to persist, right? We're getting a little bit of a change in trend now, but the reality is there's a lot of upside potential for the dollar. We're breaking above this trend line. You can see the market forecast on the monthly chart is turning up, giving us dark green shading, potentially eventually a green line. So you can see how long this lasts. These are months, right? Every candle's a month. So you can see how long these bullish moves can last once we get going. And of course, equities love it. Equities love these bullish moves in the euro, bearish moves on the dollar. All right, now let's take a look at how the sectors have been performing. Let's go to that same time frame, was at 5:15, to see how the sectors like this weakness in the dollar. 5:15 all the way up to September the 2nd of this year. And you can see, again, remember the Q's being so bullish. There's technology, there's discretionary communication services lagging a little bit here, but a nice push lately. Industrials and materials, those kind of sectors love weakness in the dollar. You can see initially during this catch-up move, we had industrials and energy and financials, but you can see during this latest rally, financials not participating and energy definitely not participating. And you can see utilities down there with some strength. Utilities have had lately. They've started to slow down themselves. Remember that big spike move that utilities had that nothing else really did? Well, since then, in fact, if you take a look at this chart, you can see it even better. Since that big spike move, you can see it's been kind of slowing down and underperforming. Look at real estate really pulling back, energy kind of hitting some resistance there, and there's our weakness in some of these other sectors. Some pretty significant bearish reversal patterns on discretionary and communication services, while some of these others, healthcare, financials, really struggling the last couple of days. So you can kind of see where a lot of the weakness was, and it's in some of these sectors that had been doing so well, and we'll see if that utility sector turns out to be a little weaker. But keep in mind, again, when we do have strength, we want the strength to be up here, and we're not really seeing that. In fact, we got light green shading still in the communication services sector, and the technology, we're still yellow. We never did really have some good green like we have in discretionary. We're still pretty yellow there on the line, and we're only at 65, so it can roll over and turn into light pink shading very quickly. Very cool. We're not necessarily like, say, above 90 like discretionary. There's a lot more strength in that area, and that's where a lot of our strength has been in technology. So we'll see if that plays out into the weakness, into that NASDAQ 100 type weakness, and filling in some of these gaps here. All right, so for our trade idea of the day, I want to take a look at a stock that's in that technology space and has got its own little gap that it can fill down here with volume. But you notice that then it does have some pretty decent support down below that. It's Marvell Technology. If you take a look at on a daily chart here, you can see that it has some support, some good volume support down below. We obviously it's on a bullish trend. We can keep going higher, but if we do pull back, we've got some good volume below. So we want to be able to have a trade. I don't have to worry about earnings till after November expiration. So up until November expiration, can I do a trade where it allows it the room? I mean, it's on a bullish trend. Can it keep going on this bullish trend? Or are we going to have some weakness here? And if we do have some weakness, is there some good support down below? Or is it going to kind of free fall? And so I don't want to, I want to have some room to work with, but I want to have some good support below. And that's where the iron condors come in. I can do a bear call spread up here, a bull put spread down there together. You can see what I've done here is I've sold the 39.37 bull put spread down here at the bottom. I've sold the 48.50 bear call spread, and this is what the trade looks like. So if I go up or down, I lose the same amount, and then anywhere here in the middle, I make a 448. So I'm willing to lose 448 if we do make a big move. But remember, I got good support right here. And we're not as worried about the upside risk because there's not as much concern about upside moves, at least by November expiration, at least without some weakness first. So if we're able to get some fluctuation up or down then up, then that's the beauty of an iron condor. Because of this move here that it's already made, it allows me to be able to continue it or pull back from it to a pretty strong support level. Whereas if I was over here, I'd be a little worried about that kind of a move to the upside that could flirt or breaking down further below this support into a big volume gap. So since we're up above it, I've got some room to come down to it now instead of being right on it. So that's the benefit of that trade. All the other technicals for this stock are relatively bullish. You can see similar to what we've done in previous trades. You got a bullish market, dark green shading and green line. You've got some bullish patterns on some of these other oscillators as well, even though we are pulling back below 30, but the negative index well below 20, so no threatening there. You look at its Ichimoku cloud, and you can see you are up above the cloud with room to pull back to the cloud and find some support down there. Very strong trend going here. So we're going to not only use that support, but also kind of use the strength of the trend as a margin of safety element as well for this type of trade. All right, and that wraps us up for today. You've heard from me. Now I want to hear from you. Use this link up here in the top right corner of your screen that takes you to our Market Outlook forums. That's available for all our subscribers, including our free subscribers. So open up any new threads there. Interact with any other market scholars by replying to their threads. And let's keep this conversation going of what we talked about tonight in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon on Twitter and Facebook too, and comment on our video. Have a great rest of your Wednesday. Remember, no Market Outlook on Friday because I'll be out of town now for the rest of the week. So have a great rest of your week, everybody, and a great weekend, and we'll see you all next time.